Welcome back to Morning Markets on Monday, the 21st of February. On screen, we can see the key market moves from Friday. The top takeaways: we continue to see a little bit of volatility within equity markets as political tensions between Russia and Ukraine rolled on. We saw higher energy prices, with Brent crude up 0.6% on the day. Of the developed market equity regions, the UK and the FTSE 100 was relatively stronger given that higher energy composition. Investors increased their exposure towards bonds, which led to a moderation in yields, which is positive for price. At this point in time, you'll hear us talking about two major factors, one being the development of inflation and economic growth expectations and how that factors into central bank policy, combined with the political dialogue between Russia and Ukraine. It's important to note that these are factors which our managers are acutely aware of and are positioning funds to where they see the best return in a risk-controlled way for investors. If you missed our podcast on Friday, please feel free to catch up on the YouTube channel where we discussed with the investment team all of these subject matters. Building on the inflation rhetoric, an area which I wanted to touch on today is Europe. As a region, Europe, relative to other developed markets, has been more in favour of keeping interest rates lower for longer and continuing the programme of quantitative easing relative to other markets such as the US, where we've already seen monetary tightening kick in, and also here in the UK, where we've had 2 interest rate hikes. The reason Europe are slightly out of kilter relative to the US and the UK is they're not facing the same level of inflation pressures, and it could be argued that they are sensitive to the prospect of raising interest rates too early after scarring from 2008 and 2011. But in recent weeks, the tone has started to shift. We had President of the European Central Bank, Christine Lagarde, note that the banks won't rule out rate hikes in 2022. This sparked a more hawkish tone, and on Friday we had more ECB, so European Central Bank officials, calling for hikes to come through this year. At this point in time, markets are pricing in rate hikes to come through by summer. This was captured within the bond market in Europe, where we experienced bonds move slightly lower on the day. We'll find out more when they meet next month. A secondary related factor is interest was the expansion of Italy's support package to combat the adverse impacts of higher energy prices. On Friday, they expanded the energy support programme by €8 billion, which was there to support companies and consumers to offset the higher energy prices, maintaining their pathway of economic expansion. Italy's already spent around €10 billion since July to hold down energy costs, and they note that this will be done not by increasing the national debt, but using the surplus from growth which has been stronger than previously predicted. The package comes at a time when Europe are facing higher energy prices, and in this environment, Italy would be one of the most challenged economies given the higher imports from Russia. As we look to the week ahead, the political situation will remain in focus between Russia and Ukraine. We'll also get a sense of sentiment from business supply chains as we hear from the Purchasing Managers Index reports of the US, the UK and across Europe. We look forward to bringing you up to date throughout the week, so please do tune in. Thank you very much for watching.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.